All right, I want to thank everyone for joining us today. My name is Lindsey McKay. I'm lead advisor and owner of McKay Wealth Management. We're going to be joined today by a couple of other people that I'll introduce in a moment. But first, I want to take care of some housekeeping things. This is a webinar where everyone is muted. So if you have questions, which I encourage you to ask at any time, please put them in the Q&A box and they'll either be answered directly to you in that chat, or we'll answer them live with Rachael and Jesse from City National Rochdale. Also wanted to thank everyone that stopped by our office for our shred event. Annually, we have the around tax time where we have you bring in all of your documents that you need to have properly shred. I know not everyone was able to come. You're welcome to bring in your materials at any time. We always have locked shred bins here. So if you're doing spring cleaning now or anytime throughout the year that you find you have extra documents that you'd like to have shred, we encourage you to bring them into the office. We also recently sent out a link for our annual client survey. So if you have not seen that in your email, I would ask you to please take the time to complete the survey. It's feedback that's really helpful for us to figure out what are the things that you're looking for that maybe we're not delivering on, or the things that we are doing that you want to see more of. So it's in your inbox and it does take about 10 minutes to complete. So just a heads up that to look for that and take some time to fill it out. And the only other thing that I'll end with is that we are looking to hire a summer intern. In the past, we've done this by word of mouth, and we've always had either children or grandchildren from existing clients work on our team. So if you have someone that you know that's family or even extended family, friends that would be interested in a wealth management summer internship, please reach out to myself or someone on the team so that we can get in contact with that individual and see if they would be a good match for our summer program. So with that, we'll kick off our economic update. A lot has happened in the last quarter. I know there's lots of questions and things on people's minds. So as I mentioned, please don't hold back asking those questions. We have Rachael Crane and Jesse from City National Rochdale that are going to be leading the webinar today. And then myself and Andrew Lee, who's in my office, is going to be fielding questions. So we've got a full team here to support you, and we're really interested to hear more from the CNR team. Rachael?
Wonderful, thank you. And thank you everyone for joining, and Lindsey and team for inviting us to speak to you today. We are changing it up just a little bit, and you're going to hear from me as well as my colleague, Jesse Flatt. So Jesse has been a portfolio manager on the team. Some of you have met him already. He's been on the team here at CNR for over 3 years and supporting Lindsey and the McKay team's clients here at City National Rochdale. And so we're going to do a little bit of this back and forth, but as Lindsey mentioned, we'd love to hear your questions, anything that's on your mind, because as interactive as we can make this, the better. Now, I particularly appreciate that, Lindsey, you had us do this webinar on a day where the market is up, and year to date, we're seeing some really good, some good numbers. And so I'm going to get started here with a bit of our outlook, and then Jesse and I will go back and forth. And as we think about where we've been and where we're going, obviously 2022 was a challenging year. We're now through the first quarter of 2023, and through today, the S&P 500 is up 7.75%. The NASDAQ is up 15%. The Dow Jones is lagging up about 2% in response to the fact that last year that was all reversed. And that's something I really want to just stress before we get into the details, is that 2022 and 2023 really still need to be thought about in the context of where we've been since 2020. In 2020, when we turned off the economy and the global supply chain and sent everyone home and shut everything down, we didn't pay for it, not financially speaking, right? As at the end of 2020, we had portfolio values that were up, broadly speaking. We had home values that went up. We had saving rates that went up. And if you were unemployed, you actually got a raise. That all happened again in 2021. A lot of wealth creation fueled by stimulus. Well, 2022, the bill came due, and we paid that bill with negative portfolio returns with the market being down. The NASDAQ was down 30% last year as an example. We're really, the inflation problem that was presented as a result of stimulus and the supply chain shortages, and now the labor shortages, which we'll talk about, is something that we're now unwinding. And 2023 is a year of that unwinding, where we are looking to see inflation come down from where it's at the peak, and then also where it's at today. And with the inflationary pressure, we know that the Federal Reserve is mindful of the fact that they want to get that down as quickly as possible. And they have said, we are going to do really whatever it takes to bring inflation down. And so that is a major issue that's driving market returns and driving the economic expectation. We anticipate that it will require a recession to bring inflation down. But when I say that word recession, I want to be really careful not to trigger the memory of 2008, because we think that there's a base case scenario of a mild recession, and that that mild recession might actually be something that we don't really feel. You know, it may be that the economy just doesn't grow or shrink slightly, which we'll talk about. We expect that inflation isn't going to be easy to get down from the 6% that we saw most recently. And as a result, we are and expecting a more modest return year than we have had in years past, not including last year. What we don't expect, though, is again, the market and the economy being two different animals. The economy, it moves slowly and is now feeling the impact of those 9 interest rate hikes. The market already paid for that last year. The market is up this year, looking beyond some of these issues. So we're going to dig in here, looking first at the market, what we're watching, and the economy, recession, and then finish up with some thoughts on portfolio positioning. And again, as we're going through this, would love to hear your comments and questions coming through the Q&A box. But I'm going to turn this time over to Jesse to dig into what are we seeing in the market? Where do we expect it to go? And are we as enthusiastic as the market's showing us here with this up 8% on the S&P 500?
Great. Well, thank you, Rachel. As we continue to evaluate the situation, the fundamentals are going to be key here. And what we're right in the swing of earnings season, and we're going to be monitoring that very closely. Earnings that have come out have actually been better overall, but this is going to be a big earnings week when it comes to a lot of the tech names, and we're going to be focusing to see how companies report. But the market is still kind of pricing in a soft landing scenario. And we think that although the markets have had some strong gains, we still are a little bit cautious when it comes to valuations, and we are preparing for, as Rachel outlined, a mild recessionary environment. So there are some opportunities. We'll talk about that as we kind of move forward in the presentation, but we're going to continue to remain focused on fundamentals, and we think that there still is some room for earnings to come down, and that's going to be something key as we move forward in this economic cycle. Typically, equity markets don't start bottoming out until we kind of get through this earnings season and earnings revisions. So we still see some potential for markets to have a pullback before we have a full bottoming out of the market. So with that, Rachel, I don't know if you wanted to move forward to the next slide here, but we think that earnings estimates still have some room to come down, and we're going to see that over the coming months as we go into our expectation for this mild recessionary environment. So we're going to be continuing to watch for some of these signals, and Rachael will fill us in here on some of these other things that we're going to be monitoring.
To go through the cycle of enthusiasm with the market and then despair with the market. But what we are really focused on here is the fundamentals in the economy, fundamentals in the market. And there are some issues that we are watching. And it's not been too long since we were talking about a bank failure with Silicon Valley Bank. And so we want to talk about a couple of issues that we're monitoring and what we think. Now, when I say the word recession, like I mentioned before, obviously that triggers a lot of fear and concern. But then you add on top of that we saw a Silicon Valley Bank failure, and now we throw bank failure on top of that. And not surprising that we got a handful of calls from clients very worried. Should we be worried about another 2008? Should we be worried about a significant cliff on the horizon? Are we going to see more bank failures? And so I wanted to just address that. If those of you who have questions about this, the short answer to that is no, we don't think so. That the overall banking system actually appears to be healthy. That what happened with Silicon Valley Bank was really specific to the way that they ran their business. And they ran their business in a kind of a risky way, where their depositors were not well diversified. And many of you read about this and understand it. But they were forced to sell assets to cover, because they saw a lot of those deposits leave. Venture capitalists, entrepreneurs had seen they were pulling money out of the bank. Well, that issue is important and definitely something that we're watching very closely. But when we look at the broad banking system, in general, it's well capitalized. Banks are significantly stronger positioning, that in a stronger position today than they were before the Great Financial Crisis. And we think about the Great Financial Crisis, where not only were banks over-levered, but households were over-levered. We're not seeing that same issue today. And that doesn't mean that every bank is going to be fine. It doesn't mean that we're not going to see some banks have pressure. We saw that with First Republic Bank as an example. But if anything, we think that now this is really indicative of it being important to understand what you own and how much you own of any individual stock, because it is really important that you're protected against any kind of pressure. But we don't expect banking failure. And in fact, Fed Chair Jerome Powell on March 23rd said the same thing. The banking system is sound and resilient with strong capital liquidity. They're going to continue to monitor that, and we are as well. But here's the point that is important here. The reason why we think about bank failures in such an important way is, well, what caused them? What were they selling? What was the issue of safety? Well, the assets that they sold, treasuries and safe assets, they were fine. There were no defaults. Defaults is something that actually really does matter. If corporations, if institutions are not paying their debt. And this, when we look at credit default swaps, essentially what we're looking at here is an indicator of how risky debt is. And that's shown, these credit default swaps are actually an insurance. It's a cost to insure the financial sector bonds. Now, of course, if there's a bank failure, you're going to see some higher cost in that insurance. But what we're seeing indicative of what's going on in the world is we do not see that investors are concerned about a banking crisis. Again, the summary of this is we're watching this very closely. The positions that we own in the CNR portfolios in any banks, we have a high degree of confidence in and are monitoring for any additional stress. It is an important time to understand what you own. Think about Credit Suisse, Silicon Valley Bank, First Republic, Signature Bank. It's important to understand the risk of the underlying holdings, but we do not expect a broad banking crisis as a result. And as a reminder, what matters the most, of course, is, in terms of portfolio returns, is what's happening in the economy. Is the economy growing? Are we seeing consumers spend? Are we seeing profit growth from corporations? Well, as many of you follow our speedometers, we have a couple of updates here to our speedometers, and these are not a surprise to us that our economic and financial indicators are primarily red and yellow. The economy is slowing. That is something that the Federal Reserve again said that they were going to do, that they were intending to do as they were raising interest rates, and that's what it takes to bring inflation down. The good news is that inflation has been coming down. And despite the fact that the economy is slowing, it's not, again, falling into some kind of cliff. What we're seeing is stimulus went into the system. It created economic growth and positive portfolio returns. As stimulus is coming out of the system, we're seeing the opposite of that. The market went down last year and the economy is slowing this year. What we see is that consumers remain quite healthy. They're resilient. In fact, when you look around, and I know that this is the case in the Pacific Northwest as well, is that consumers are healthy. You know, we're seeing malls are busy, restaurants are full, airports are full, people are spending money. This, we think, is indicative of the fact that consumer is healthy and resilient. We'll talk about why that matters. So what does that mean about a recession? I use that word. Well, we expect that in 2023, a range of outcomes here in terms of economic growth, where the economy could grow modestly to shrink modestly. And this, we think, is really driven by the fact that we do still have positive signs in the economy. We do not expect a significant drop. Now, corporate profit growth, again, a wide range of outcomes. When we look at CPI, inflation numbers, we do expect inflation to be coming down, that the actions the Federal Reserve have taken will be working. And by year end, we expect inflation to be in that 3 to 3.5% range, either looking at headline or core inflation. And that interest rates are likely going to remain elevated, that the Federal Reserve has been clear in their intent. But the unique aspect of what the Federal Reserve is dealing with today is something that is not been seen before, which is that consumers have been quite resilient despite higher interest rates. A lot of that has to do with the labor shortages. Now think back again in 2020 when we turned off the economy. In 2021, we had supply and demand imbalances. But the demand for goods was high, as an example, but the supply for goods was low. Well, that is improving, and that we think is going to continue to improve. But it's shifted, and now our primary supply problem is labor. We lost about 4 million people in the workforce. And as a result, hiring has remained strong, that we have about 2 job openings for every 1 person on unemployment. And this has presented a bit of a dilemma. But when consumers are resilient and when hiring is strong and private sector demand is strong, it is keeping inflation elevated. And so the Federal Reserve is monitoring that, and we are going to continue to watch that. Now, on the other hand, though, those higher interest rates have led to credit conditions, so the availability of borrowing to come to tighten. Now, also with the Silicon Valley Bank failure, banks are also tightening up standards. Now, when banks have tight standards and it's harder to get a loan, of course, that reduces the amount of economic activity. And when we look back at 2007, 2006, you'll see here that credit standards were very loose. Back in the good old days when you could get a mortgage without having to tell anyone how much money you make, or at least prove it. Then we saw the pendulum shift. And in 08 and 09, we saw tightening standards, the standards tightening significantly. and then they've eased. Well, then they've tightened again. Well, as banks are tightening standards, that also is an impact of that is slowing the economy. Weaker demand versus stronger demand, weaker availability versus stronger availability. This is actually going to help the Federal Reserve in their effort to bring down inflation. Because as there's more or less credit, economic growth is correlated. And they know this, right? This is the tool that, one of the tools that they have, but their primary tool. And households, we rely on credit to support our spending. But when we think about businesses, businesses rely on credit to invest and to hire. So with credit tightening, without this expansion, economic activity will slow down. All in an attempt, of course, to bring down inflation, to slow down that growth that is creating all of the demand that is driving the inflation forward. But with that being said, this slowing economic data, what we do expect is this mild recession. Some more data to show that. And I really love this chart on the right-hand side, this household debt service ratio. So there's been some news recently about credit card debt going up. We've heard some commentary about that. But when we look at the ratio of debt to where we've been in the past, the household debt, meaning the total household debt payments as relative to the total disposable income, we're actually at about a 40-year low. Delinquencies, which are another indication of consumers being in bad shape, are still actually low. What's hard, I think, as an everyday investor, is that when we look at the news, what you're going to hear about is these upticks, right? Consumer household debt going up, delinquencies debt going up, but what you don't see is these longer term charts about where we are relatively. With household debt service being low and with delinquency being relatively low, this is an indication that consumer balance sheets are in a solid position. Compared to 2007, when consumer balance sheets were quite low, the impact of that is that if we see and when we see the economy slow, consumers can continue to spend. And consumer spending is 70% of US GDP. So as consumers spend, we're going to continue to see that positive impact on economic growth. Now, a question just came in that I want to address just right away, which is about the labor market. I made the comment about hiring being strong and the labor market showing positive resiliency. And here's what the importance of that. When we look at the labor participation rate, we've seen that decline. We saw about 1.5 million women, mothers particularly, leave the workforce. We saw early retirees. We saw a few 100,000 individuals pass away from COVID under the age of 65. And so the impact that has had is that we have 2 job openings for every 1 person on unemployment. So the number of jobs available is strong and positive. That ratio of job openings being available relative to the number of people on unemployment means that the economy should grow. In the news, of course, there's recently been a lot of layoffs, particularly in the tech sector. And there's a couple things to note there. First of all, tech companies really ramped up their hiring in 2020 and 2021. If you take Salesforce, for example, Jesse and I can actually see the Salesforce building outside of our window today as we're in the office. Salesforce went from 50,000 employees to about 86,000 employees in 2 years. And then they laid off 10% of their employees. So they laid off 8,600 employees. Well, they're still far ahead of where they were. And where they were is they still have quite a strong labor market. the labor demand in the tech sector but they overhired, and now they're trimming that back. That's actually not a significant segment of the overall labor market. Where the jobs are available are primarily in the service sector. So we think about transportation, leisure, and hospitality. Very strong sort of job market in healthcare and in education. Very strong market in government jobs. And there's one theme that goes along with all of this, and that is you're not able to work remotely. So the tech layoffs are important, and they are indicative of the fact that the economy is slowing down, that corporations are trimming. But fundamentally, the job openings are in other segments of the economy. And in fact, tech jobs alone are a very small percentage of the overall economy. The highest, the significant employer in the US is actually small businesses. And that's where a lot of jobs are open. So the question being, well, what is that? How can we say hiring is strong when there are layoffs? And this is the dichotomy. As the economy slows down, we're going to hear more and more news about layoffs. We're going to have fewer job openings. That is the goal. The goal of the Federal Reserve is to slow down the demand for labor, because wages keep going up. And as wages go up, inflation stays high and stays sticky. So they want unemployment to increase. But they're not going to see a significant amount of that because of those jobs being available. Now, there's some discussion, and I'll just throw this out there about, well, what type of jobs, right? I mentioned a lot of the service industry. Is this good? Do we have skilled labor? There's a lot of these conversations going around. But the point is, and the fundamental point is, there are jobs available. If you're out of a job, you can get a job, even if it might not be the job that you want. That's positive for the economy. So consumers being in a solid position on their balance sheet with jobs being available, we expect the highest probability outcome here is a mild recession, where GDP growth is 0 to -1%. And it may be a recession again that we don't really feel. Now you'll see here this possibility of a slow growth, where we actually don't get a recession, where the economy might grow a little bit. Well, that could happen. We saw a lot of people come back to work. That would alleviate some of that wage pressure. We'd see the economic growth come from that productivity. You also see this normal recession, where we might actually see the economy not have a mild recession, but shrink more. That's going to have everything to do with whether or not inflation is coming down. And there are really two types of inflation that we really need to look at. One is this core inflation, right? Headline CPI. That's where we peaked over 9% back in June. And now most recently was 6%. The Federal Reserve actually it turned out they were right. They were right that inflation was going to come down on its own, particularly the inflation of goods, the price of goods. Those prices have been easing. Energy prices have fallen, and that's helped. What they're concerned about, and what we're seeing, is the fact that this core CPI, so services, is going up and has only had modest improvement. That has everything to do with labor costs. And so industries that have more high, labor intensive, those inflationary pressures are higher. Well, how do you get inflation down when we've got a high cost of labor and we have this challenge? So the Fed has a dilemma. What are they going to prioritize? Are they going to prioritize inflation, financial stability, price stability? Are they going to raise interest rates further, which will put some more pressure on banks? Banks particularly that own a lot of bonds that have a negative relationship, an inverse relationship to higher interest rates. Higher interest rates are going to negatively impact bondholders. So that's you, that's me, that's banks, that's industries where we see a lot of bond holding. But then on the other hand, are they going to be focused on inflation? What our view is that they will continue to prioritize bringing inflation down, but that they are going to be cautious. So likely we're going to see them continue to put pressure with higher interest rates on the economy. The challenge that they face in addition to this is that there are long lags, right? So it can take more than a year for a Federal Reserve interest rate hike to impact the economy. Again, that's why I want to reiterate that the market was down last year, but the economy hadn't slowed. The economy is now slowing as a result of those interest rate hikes last year. The market is up this year in anticipation that the Federal Reserve might be close to done on these higher interest rates, done with raising interest rates. So we've had this delay of impact, right? This is a very unique situation though, as we think about the COVID circumstances, distortions in inflation, the supply chain. And so the Federal Reserve is monitoring this all very closely. Our view is that we're going to likely see another hike from the Federal Reserve, probably 25 basis points or 0.25%. And then they're likely going to hold, that they are not going to continue to raise rates because of that delay, and they're going to monitor and watch. We do not expect, and they have said that they do not expect to cut rates in 2023. The market has started to, has some optimism. So Jesse had talked about how we think that the market is a little bit more optimistic today than we are. But the expectation we have is that the short-term rates staying higher for longer likely means that the market will have more volatility. So in summary to all of this, we're watching the economy, we're watching the market very closely, and we're implementing this outlook into the portfolio and portfolio positioning. So I'm going to turn it back to Jesse to talk about some of the moves that we're making in portfolios and have made, and the expectations about this year and potential next steps. So Jesse, I'll turn that over to you.
Thank you. So bringing it all together, as Rachael outlined, we have this slowing of the economy, we have the Fed raising interest rates and the pressures that this is causing within the economy, and how are we going to take advantage of it? So number one, we are focused on holding high quality US stocks and bonds in your portfolios. And portfolios are very well diversified and built across sector and industry. When we take a look at our underlying strategies, we want to point out what type of financial sector exposure we have, just in light of some of the pressures that have been exposed through the Silicon Valley Bank failure as a result of interest rates going up very quickly. So important to note that in our core US equity strategy, there's no exposure to regional banks. In our equity income strategy, we do hold some regional banks, but these are banks that are very high quality, and we feel very comfortable owning them. Just important to note, I'm sure everyone is aware at this point, but we didn't own Silicon Valley Bank, we didn't own First Republic, we didn't own Credit Suisse or Deutsche Bank or any of these banks that have really been in the headlines and under pressure. When it comes to the fixed income side of the portfolios, we do have some exposure to very high quality big money center banks on the taxable side of the fixed income equation, and in the tax exempt side, we also do have some exposure to the big money center banks, but no regional exposure there within our strategies. So as we continue to look ahead and consider the different probabilities that Rachael outlined earlier, we have been, starting in 2022, de-risking client portfolios with the expectation that we were going to get a mild recession this year. So throughout 2022 and into 2023, we have been reducing the riskiest asset classes, those that tend to do really well when the economy is booming, tend to underperform when the economy is contracting. So we've been reducing exposure to some of those more cyclical industries, and we've been increasing our exposure to high quality investment investment grade fixed income. So in general, overall, of course, this will apply in a very tailored way to everyone's portfolio here on the call, but for in general, we're underweight overall equity exposure and have a lower risk profile compared to, say, where we were in the beginning of 2022. So underweight equities somewhere between 5 to 10% overall, and more defensively positioned, with the expectation that we do get this mild recession either moving into the summer or maybe into the fall of this year. And as we have position portfolios more defensively, you can see here that our underweight to equities and modest overweight to investment grade fixed income being a little bit more defensively positioned already because of the anticipation of mild slowdown actually benefited portfolios when we started to have some more volatility as a result of the Silicon Valley Bank fallout. So you can see on the left here, the areas where we've been overweight have done a little bit better, particularly during the times of stress relative to the areas where we are underweight and have zero weight exposure. When we consider the global macro environment and some of the uncertainty, considering some of the tensions with still with China and Taiwan, the prolonged war between Russia and Ukraine, and we evaluate the opportunity set looking across the globe using our proprietary framework that we do internally, we still see the US as the best place to be positioned. So to steal one of Rachel's sayings here, when we look at the global macro environment, we consider the US as the nicest house in a bad neighborhood. So we still think that the US is most resilient. The policy in terms of the Federal Reserve doing everything in their power to bring inflation back down. When we consider the outlook amongst other major economies, we still like the US, and that's where we're positioned right now. However, as the macroeconomic environment changes and our internal proprietary scoring and we challenge our assumptions, change, and we do find opportunities outside of the US, we will tactically shift portfolios back. But for right now, we feel most comfortable being positioned in the US, and we think the US is the best place to come out of this environment that we're in. When we consider where what are some of the signals that we're going to be evaluating and monitoring from here, these are some of the things that we think are very important. They're going to be telltale signs of where we are within the economic cycle. So as we look into the summer, into the fall, going into the end of the year, really the economic activity or bottoming out process, when we start to see earnings revisions to the upside, and also we're going to be monitoring very closely the credit cycle and how bonds respond as the economy begins to slow down and if we get the recession that we're anticipating. So these are all signals that are going to be very key in terms of how the economy evolves and how we'll be adjusting portfolios as a result of some of these indicators. So potential next steps as we consider the outlook. What's really important is we have a playbook. So depending on if we get any of the scenarios that Rachael kind of outlined, the slow growth environment, the mild recession, or the normal recession, we do have a playbook and we're prepared. So right now, as just in summary, we are modestly underweight stocks and we have a modest overweight to bonds, and we will be maintaining this position until there's further clarity in the data and if one of these other scenarios unfold. But if we do get a best case scenario for maybe people start coming back to work, as Rachael said, and that alleviates some of the inflationary pressures and it looks like we're going to go into a slow growth environment, well, that would be an opportunity for us to lean back into stocks and take advantage of the recovery as the economy continues to grow. But if we get maybe some exogenous shock or some other type of slowdown, some other type of issue within the economy that would cause a more normalized recession, well, we're going to get even more defensive in client portfolios, continue to add to high quality fixed income now that we can lock in yields at 4.5% to 5%, and we'll add to more of those type of fixed income instruments and reduce our equity exposure and get even more defensive into those high quality stocks in client portfolios. So we do have a plan. Depending on how things unfold, we'll continue to be proactive on your behalf. And I guess with that, we're going to hand it back for maybe a little bit of Q&A.
Yeah,
Great.
perfect. Thank you. Sorry to jump in there. I know there were a couple questions about the layoffs, specifically about the tech sector. So Rachel, thank you for being all over that. Question about the debt limit and how that might kind of impact things going forward. Just kind of recap, in January, the U.S. reached its debt limit, with the White House saying negotiations are non-starter and House Republicans putting a bill forward. Is that a concern for CNR, or is the possibility of even a default something that CNR is even considering at this point, or being anything proactive about there?
Yeah, Jesse, why don't you take that one?
Sure, happy to. So the debt limit conversation is not something that we are concerned about from a economic standpoint or portfolio positioning standpoint. The reason being is that typically when you have split divided government, and the debt ceiling is always kind of something that's used as a negotiating chip, and there's going to be a lot of hyperbole between now and whenever the debt limit gets raised. And so we do feel that this is not going to have any material impact when it comes to the U.S. economy. We don't think it's going to be a focus. There will be a lot of noise and a lot of headlines. And the last time, actually it was 2011, when we had a technical default, or the S&P downgraded our credit from AAA to AA+. And there was a little bit of volatility a month after that happened, or kind of during the standoff. Maybe the market was down 5 to 6%, 7% or so. But 12 months after, the market was up double digits. So we don't view this as being a major headline. We do think it will be resolved. It will get lifted. And really the key consideration for this year as we move forward when it comes to the global macroeconomic outlook is really going to be how quickly inflation comes down, if it continues to remain sticky, kind of what the policymakers do in response, and do they continue to raise interest rates or pause. And we think that's going to be more of a driver of the economic cycle this year than the debt ceiling. But it will be in the news. There will be a lot of hyperbole, but we don't feel it's going to have any major impact on the economic outlook, and we're not making adjustments to client portfolios as a result of it.
Perfect, thank you. A question here about kind of building off what you had mentioned about the U.S. being the best house in a bad neighborhood. Isn't our economy tied and related to the world economic activity? And then there's been talk in the news lately about possible alternative to the U.S. as a reserve currency, and what impact might that have?
Yeah, I'll take that one here. So when we look at investments and we think about investors being rewarded for their investment, even though we have challenges in the US economy, we do still think that investors will continue to be rewarded. So the question here being, how impactful is the US economy on the global economy? And how impacted by the global economy is the US? It certainly is. And as we saw, obviously in the pandemic, the impact of a global supply chain on the US, that we're not independent economies. We have a global, the global economy. That being said, there's one really important difference about the US, and that is that the US is a place where money floods to when there is concern globally. So for example, when there's major geopolitical issues or there's global recession, global financial crisis like in 2008, money floods to highest quality, and that comes to the US. The US is different also in that if we compare an investment in the US versus China, for example, we have a central bank that doesn't really meddle in the markets. Whereas when you look at the UN and you look at other currencies in other countries, not all countries, right? But in some countries, you see a government that it actually gets in there and messes things up for investors. That's not what's happening here in the US. But I think the point of your question is, if the global economy is slowing down, will that have an impact on the US economic growth? And the answer to that is yes. And so we don't anticipate that we're going to see a boom in economic activity in the US, despite the fact that the global economy is slowing. We do expect that that will have an impact on US economic growth. But that doesn't mean that the global economy is going to take the US down into a recession. Now, if we see pressure on that front, then we'll make changes and make recommendations in client portfolios to become more conservative. We don't see that today, but rather than being directly invested in emerging markets or in Europe, specifically, we're focused here on investments here in the US because we think fundamentally the US economy has the best economic engine and therefore should return the most positive investment results here in the near term. I hope that answers your question.
Excellent, thank you. Question about the upcoming presidential race next year, the different kind of personalities involved, and then maybe tangentially related to that, a question about, you mentioned sort of external catalysts that might provide opportunity for looking at kind of global and emerging market exposure. Would there be any internal catalysts within the US that might also provide opportunity to look outside?
Great. So why don't I take the first half of that, and then Jesse, I'll let you talk about those catalysts and internal or external for investment opportunities. So speaking about the political environment, so Biden versus Trump, what's the impact on the economy? When we look at historical data, what we've seen is that the economy grows and markets have positive returns under a variety of different administrations, Democrat or Republican, mixed and or majority in Congress. And that's because what the market cares most about is economic growth. Now, there are some policies that impact that economic growth, and that's what we're paying attention to. But the market also will react to news in the short term, good or bad, or perceived good or bad. Let me use an example, or two different examples. So in 2018, is it 2018? I'm thinking, it's not 2018, I'm sorry, 2017, the Trump tax reforms were being discussed, and the likelihood of those passing was relatively high. Now, they didn't pass until the following year, but the market went up in anticipation of lower taxes because that leads to more positive economic growth. Now, if we look alternatively at the Biden administration as fiscal policy, so the Biden administration announced the infrastructure package. The market likes that. The market likes to know that money's coming into the economy, either for a tax cut or through spending. Those policies are really important. And our job, and for those of you who are seeing our clients, which I know is not all of you, but our job and your money manager's job is to take all of this information and put it through to say, okay, well, what does this mean about Costco? Is Costco going to have positive earnings? Are they going to have better earnings than Sam's Club and Walmart? Are they going to have worse earnings? And so we need to determine what companies benefit and what to own in your portfolio. And that's a long way of saying the market cares about policy as it relates to economic growth. It doesn't care as much about people. We're going to hear a lot of news, though, about the debt ceiling. We're going to hear a lot of news about the presidential election, and that might create some uncertainty, and that might create market volatility. But we're invested based on the fundamentals of economic growth, corporate profits, and that we think is going to be and has historically been the #1 driver of reward for investors. But why don't I turn it over to you, Jesse, to finish that second half of the question, which is, well, what are some of those catalysts that might change what we're doing and change our outlook of where we want to be invested?
Yeah, no, absolutely. And so I guess two of the biggest catalysts and two of the things I would posit that are some of the biggest risks out there that keep us up at night has to do with the geopolitical situation when it comes to China and Taiwan. And there's been a lot of saber rattling. There's been some military drills, and so the tension there on the Pacific Rim is not something that we feel comfortable with right now. But for example, a catalyst, let's say there was some type of agreement or resolution, and there was a more favorable outcome and less tension there. Well, that would certainly make investing once again, say in China, or if China's policies were a little bit more favored towards kind of an open economy, as opposed to some of the behaviors that we've seen where they've really cracked down with a very heavy-handed hand on even some of their domestic industries, because of maybe what they feel is kind of runaway capitalism, or they've really kind of put ideology above their own economy. So those type of things would provide a catalyst. The other thing I would say when it comes to, of course, the war between Russia and Ukraine. So we have throughout that process, once the war started, we went through client portfolios and we made sure that we didn't have exposure to any European companies directly, but also that we didn't have high exposures from US companies that derived a lot of revenue from Europe because of the strain of the war and certainly the impact that it has on Europe. So if there was, for example, a resolution, an off-ramp to the war, well, that would potentially present some opportunities where we would feel more comfortable being invested in other parts of the world. So, we continue to have these debates internally. And once again, we do have kind of a proprietary framework where we're evaluating different economies and where we see opportunities, and should the opportunity set reflect a better opportunity outside of the US, we'll certainly take advantage of it. But right now we still feel the US is the best place to be positioned. And however, if one of these catalysts were to emerge, then we would certainly consider that and factor that into our framework.
Great, thank you, Jesse and Rachel. I appreciate all of your thoughts and insights. One of the things that I think we've touched on a little bit, but heard have come up is this: what should we be doing? People feel the need to act. So maybe we could just talk a little bit about if you are in a managed portfolio, whether or not CNR is your manager or another manager that's out there, just kind of some of the actions that are being taken on clients' behalf so that it can put to rest this concern of, I need to do something, because they know that there's individuals, institutions, groups that are taking action on their behalf.
And thank you, Lindsay. That's such an important question, because we're bombarded with news about the market and the economy in a way really we never have before. We think back to 2008 even. Obviously, the global financial crisis, the worst economic and market scenario we've been through since the Great Depression. But we didn't all have smartphones. Many people did, but we didn't. We weren't fed news constantly just to our phone. We didn't see stock prices every minute, all day, every day. We didn't see your portfolio value maybe every minute, all day. And as technology has increased, this question comes up more and more and more. What should I do? What is the action? And one of the things that's really important to know is that that's part of what you are paying a manager for, right? For us to be proactive in your portfolio, for us to make the changes that are necessary based on that news. What's hard to understand is that 90% of the news you're hearing actually is meaningless in terms of whether or not we should make a change, whether or not it means Costco will make more or less money. And our job is to filter that out and make the adjustments where we are needed. Now, outside of that, though, I would say you also want to be very cautious in making adjustments based on how you feel. Now, this is why I know Lindsey and the McKay team do such a thorough job and great job of financial planning, is because that financial plan is the number one guidance of what you should do. Now, that's why CNR, we only partner with great advisors like Lindsey, where we don't build portfolios in a vacuum. We build portfolios specific to your goals. Now, of course, if your goals have changed, if something significant has changed in your life, you're already talking to Lindsey and the team about that. She's translating that information to us where we might make adjustments. But history has taught us one thing, and that is, if you stick with your financial plan and the investment portfolio that best is built to reach those goals on it, reducing risk and reaching those return targets, you're going to be in a much better situation than if you act on those emotions. And it's something that Lindsey and I talk about very frequently as we look at all the client portfolios together, the ones that are with CNR, and I know with other managers, she does the same. And making sure that once we have a solid plan, a solid foundation, we don't want to have any knee-jerk reactions to news. We want to make smart, consistent decisions that are reflective of fundamental analysis and data that are coming from the companies that we are invested in. And so we don't necessarily want to do anything unless your financial plan dictates that. So that's my portion of the answer, Lindsey, but of course would turn it to you as the expert on the planning piece.
Yeah, no, I appreciate that, Rachael. Thank you for your comments. And, it's really what our discussions are all about, whether it be direct with clients or between ourselves and portfolio managers. We're helping with some of those decision makings about, is it appropriate to make decisions, changes, and which of those are, as Rachael said, really being intentional versus avoiding being reactionary. So if anyone on the call has questions about their specific circumstances, want to review their accounts or revisit their financial plans, please give us a call and we'll make sure to have that conversation. If it's on your mind, we want to make sure that it's something that's being discussed. So with that, I'll thank Rachael, Jesse, and Andrew for their time today with information, and thank all of you for posting your questions. We appreciate knowing what's on your mind. Just as I said, it's hard for us to know unless you're asking specifically. So if there's additional things that did not get asked, please reach out so that we can continue this discussion. And then I will just once more reiterate, please take the time to complete our client survey that went out. We also are looking to hire summer interns. If you know any college students that would be interested in working with our firm over the summer. And next month, we'll be having a Social Security webinar. So if that's something that's applicable to you or someone you know, please keep an eye out for those details. So with that, thank you, everyone, and have a great afternoon.